You hit buy hundreds of times one tap, a green number, and instant confidence. Your brain plays a movie. I'm early. I'm smart. I'm basically Wall Street. Pause. Turn off the fantasy because most beginners don't know what they just bought. Today we're dissecting the buy button, what physically happens to your money. This is stock market for beginners. No hype, no secret signals, no magic patterns, because the market isn't a casino. It's a massive digital marketplace. And on a marketplace, every buy needs a seller on the other side. When you buy a popular stock, your money doesn't teleport into the company. In the secondary market, you're buying from another investor, retail, or a big fund. It's like a crowd shouting prices, bids, asks, and a deal happens in between. That gap is the bid-ask spread, one of the hidden costs beginners ignore. Now meet the broker. The app feels friendly, but it's a transaction machine. Bright charts, push alerts, buy now, because activity is how brokers earn. Whether you profit or lose, the broker still gets paid for the trade. So the first investing lesson is brutal. The platform wants you clicking, and every click has a price, fees, spread, taxes, and bad timing. Do the math. Frequent trading can quietly bleed your capital over a year. That's why How to Invest starts with friction, reduce unnecessary trades. Next question: what is a stock, really? Not a line in in-app ownership. Imagine a billion-dollar business split into shares. Buying a share equals a slice. Here's the mental trap: you treat investing like shopping, not owning. When you buy a phone, you're a consumer. Money leaves your life. When you buy stock, you switch teams, you become an owner of cash flow. The goal isn't quick profit, it's owning assets that work while you sleep. But beginners turn ownership into gambling. Up 5%, sell, down, panic. That cycle feeds the system. More trades, more fees, more emotional mistakes. And who's on the other side? Often algorithms and institutions with speed. Reading a signal in a chat won't beat a bank's models in milliseconds. So stop trying to be the fastest trader. Play a different game. You don't need to fight in the ring, you can own the stadium. Now let's build a real long-term investing strategy with risk management. Step 1. Understand the 3 core tools: stocks, bonds, and ETFs. Stocks: higher growth potential, higher volatility, higher emotional pressure. Bonds: you're lending money for interest, more stability, usually lower return. Bonds still have risk. Default risk and inflation risk are real. ETFs: diversified baskets. 1 ticker, many companies, less single stock drama. That's why index funds and ETFs are a favorite beginner investing choice, because diversification reduces the chance one mistake ruins your portfolio. Now the silent killer: inflation. Cash feels safe until prices climb. Doing nothing is still a decision, one that can shrink purchasing power. So the question isn't invest or not, it's how to invest intelligently. Rule 1. Shut off emotions. Markets are engineered to trigger fear and greed. Red charts scream sell. Green charts whisper buy more. That's biology. Market makers understand your brain sometimes better than you do. Rule 2. Buy what you understand: real businesses, real products, real demand. Don't chase a stock just because it jumped 100% today. That's a trap. Look around. The services you use daily are often the businesses earning daily. Stop being a battery for the economy. Become a beneficiary of it. Now here's the simplest strategy for 99%: invest. Then stop watching hourly. Seriously, buy quality assets and forget the password for a while. Your nervous system will thank you. Your portfolio may too over years, because the stock market rewards patience. Wealth moves from impatient to patient. This is compounding: small, consistent gains stacking into something massive. Dividends aren't fun money. Reinvesting dividends is how compounding accelerates. If you eat the seeds, there's no harvest. Reinvest to grow the asset base. Rule 3. Consistency beats size. Start small, show up monthly. That's dollar cost averaging. Buying in all markets reduces timing risk. Market down, you buy more units like a sale. Market up, your holdings grow. This strategy kills panic, because you stop needing perfect predictions. Now the warning label: the market is a jungle. Don't enter as prey. If you enter like a gambler, you'll pay tuition and losses. Your mission isn't to be a millionaire in a week. That's influencer fiction. Your mission is to protect earned income and outpace inflation over time. You don't need genius IQ. You need discipline and a repeatable process. So here's the buy button checklist before you invest a single dollar. 1. Know the asset, stock, bond, or ETF. What exactly are you buying? 2. Know the cost, fees, spread, taxes. Your return starts after friction. 3. Know the horizon. If you need this money soon, don't gamble it. 4. Know the plan. What triggers a buy? What triggers a rebalance? No improvising. 5. Know your risk tolerance. If a 20% drop breaks you, adjust the portfolio. A simple global portfolio often starts with diversified ETFs plus safer reserves and an emergency fund. Matters so you never sell investments in panic, because panic selling is how temporary volatility becomes permanent loss. Remember the big idea: a share is a factory, a store, a pipeline, not a number. Once you see that, news stops controlling you and long-term ownership starts. While people eat, travel, call, and work, businesses generate revenue. Owners participate in that growth. That's what investing is meant to do. So don't donate money to the market through impatience and overtrading. Build capital brick by brick, boring, reliable, and scalable. And if you want to test your mindset, answer this: what's your time horizon? Is it months? Then prioritize safety and liquidity over risky stock picks. Is it years? Then diversified long-term investing becomes your advantage, because the market's secret isn't a pattern. It's patience plus process. Final reminder: this is educational content, not personalized financial advice. Subscribe, like, and follow for more investment insights.